On today's Retirement Makeover, I talked to Spencer. Spencer's been putting money diligently into his pre-tax 401k account, but he's starting to wonder, will the tax impact of required minimum distributions more than offset the tax benefit of putting money away pre-tax today? Tune in as we help Spencer understand the impact of required distributions in the future, as well as the things he can start doing today to mitigate a significant tax liability down the road. It's all coming up next on today's Retirement Makeover. Joining me on today's Retirement Makeover, Spencer. Spencer, thanks for being here.
Sure. Yeah. Thanks, James. Thanks for letting me come on.
Absolutely. Thank you for coming on. I wanted to start with you're 48 years old. You're thinking of retirement in the next couple of years, so not too
Correct.
long. Do you mind
Right.
providing a basic overview of what your career's been like and what you've done to get to this point before we start looking at challenges and opportunities going forward?
Sure. Yeah. So I've worked for 25 years now. I do mostly enterprise software. So it's like internal billing software or sales software or HR software, that kind of stuff. And I have a family. I have 6 children, ages 10 years old all the way up to 26 years old. So a big range there. And I'm just kind of been saving my whole life. My wife and I are very aggressive with saving and investing and have kind of tried to now figure out how we now pivot and what we do next.
So you got to stop at 6 children. We just had our second, and I thought, hey, 4 for sure is going to be how many we have, and it's just rocking my world in a way that having
It
6 is
it never gets harder than
accomplishment.
having two. So once you've had two, that's kind of like it plateaus after that. So
Let's flip this conversation. I might need to ask you parenting advice and family advice, but
no, I don't know, but I am not the best one to ask about that, unfortunately.
all right. Well, then we'll talk about finance, I guess. So you've been a diligent saver. We're going to share numbers in a bit. What are the challenges that are top of mind for you as you think about retirement, as you think about what's ahead?
Challenges, I would say, I think at a certain point, I just don't know what comes next. I feel like it's I shouldn't say easy, but it was clear to me the strategy to save a lot, which was put a lot away, pay yourself first, all those buzzwords people talk about, live at our means, stuff like that. But at a certain point, I'm like, I don't know now how to pivot things. I don't know, like, should I think of some strategies now to spend it down or to move things around? I don't really know. So that's kind of my next question, I guess.
And with that, there's so many things when it comes to retirement. There's withdrawal strategies, like you said. There's what do we do to minimize taxes? There's the
Yeah.
investment component. And I've got to imagine there's a handful of those that are top of mind. One thing that I saw with your plan, Spencer, is taxes are probably both
Yeah.
a potential significant challenge for you if nothing is done, as well as a potential opportunity if the right thing is done.
Okay.
So if it's okay with you, let's start there. And then that might tie
Sure.
into some of the
Please.
other things that we can then go over. So Spencer, here is your
Yeah.
dashboard. This is just a reflection of investments, of net worth, of everything that you have. And as you mentioned, you and your wife have been diligent. You've lived within your means. You've saved. You have saved money specifically to pre-tax retirement accounts. So 401k plans, traditional IRAs. You also do have a Roth IRA. You also do have some brokerage accounts or joint accounts. One thing I know you shared before was, look, is all the tax benefit that I received from putting money into 401k plans, is that going to be offset or even more than offset
Yes.
by the
Right.
liabilities I face in the future with required distributions?
Yeah. That's my off. I have that question a lot. I'm like, okay, cool. I saved some taxes this year. Maybe when I was 30, right? It was a big deal. It was going, whatever. I didn't have to deal with it. But now I'm thinking, wait a minute, at a certain point, obviously I hear about this required minimum distribution. I got to take some out. Does that mean I'm going to have this huge income draw? I have to think about that, I think. So,
Yeah. That's what we're going to look at a few things, but that's going to be a big focus of this because like I said, that represents both a significant challenge as well as a significant opportunity if done correctly. So here's what we have right now, or here's what you have, I should say, in investments split between IRAs, Roth IRAs, regular brokerage accounts. You also have some properties. So you have your primary residence, of
right.
course, and then these condos in the Airbnb property. What's the plan with those long term?
So, over the years, probably starting in like, I think it was like 2010, we thought, okay, we're saving a lot in we actually paid off our house really early. It was a main focus for us. We did not like debt, and we had maxed out our 401k, and we were saving a lot. We had this chunk of money. So we're like, okay, well, maybe we'll just buy a condo nearby that we can rent out, thinking, oh, that'd be fun. And it actually has been kind of fun to do that, right? Because we manage it ourselves. And then we added a second one. And then there's a third one there that we own somewhat near a university that our kids can live in, and we can rent it out to other people and stuff like that. And our thought was, okay, this will be nice because we can have some income. Honestly, looking back, property's interesting and it's fun, but it's a lot of work too. I mean, like 2 weeks ago, I had to replace a hot water heater, and then I was putting up new blinds 1 week. And so like it's work, and sometimes that's gratifying because I can actually go do something instead of just working on the computer, and I can kind of like feel like I'm doing something. But at a certain point, I think we're probably going to divest of those, or, sell them off at some point, probably, in the next few years or maybe decades, because ultimately, like, it's not an easy thing to invest in those. That's my opinion. So
got it. Maybe not the thing you want to spend your retirement years doing necessarily.
Yeah. Right.
So here, I made some assumptions. So you input a lot of this in terms of the property when you purchased it, of course, the value, purchase price. I went in and just estimated, Spencer, some accumulated depreciation based upon approximate what percentage of the property is the land versus the home. What's the annual depreciation? So some of this is an estimate. I want to make that very clear of this could be more detailed, but I think it's probably not far off. I did that just for each of these of depreciation, accumulated depreciation, because when we do look to say, if you start to sell these, and I know in this, you did indicate a year of sale for each of them. Well, there's going to be capital gains, long-term capital gains on the growth of the asset, but then there's also depreciation recapture on any depreciation you've taken on these properties. I say that seems totally unrelated. Hey, we're talking about Roth conversions or withdrawal rates. What is it? Well, in those years, every year that you sell something, that's increasing your income on one side, and we do need to account for that on the other. So just as an FYI, I went in and made some assumptions on this as we go through there.
Yeah, that's helpful. Not something I would have thought of, because I mean, I don't know all that stuff. So that's good.
This will give us, I think of this as a 30,000 foot view. We're about to look at the entirety of your retirement to get a sense of what might the peaks and valleys of various tax years look like, so we can start to make some good decisions.
Can I, without getting into spoilers, are we going to see some graphs? Because I love a good graph, and I hope we see some good graphs.
We're going to see some good graphs. Let's get to those right now. So enough on this. We got a couple million net worth in properties here. You've got about 3.5 million in investments, cash, of course, here. The goals that you have is you would like to retire at 50. Now, I know part of this is part of the question too. What do you do when you retire? Do you retire early when it feels like, hey, you're getting a bunch of momentum, things are going well financially? So we'll come back to some of that. But the assumption being, what if you stop working at 50 and never work a day in your life ever again, earning $1? What if your expenses are $9,000 per month of core monthly expenses that will last for all retirement? We're making some assumptions with healthcare costs. We're making some assumptions about long-term care. This is years and years into the future. So some of this is just a best guess, which sometimes financial planning, you know what you're looking at. Sometimes you're taking some educated guesses. On top of the monthly expenses, we're going to assume a travel goal. So what if you travel? Now, I saw this was only for 1 year. I think we'll want to extend this.
Oh, yes, please change that. I probably didn't do that correctly.
We'll go through here to make sure. But if you think of you and your spouse having an extra $20,000 per year to travel on top of your core monthly expenses, you retire at 50. How many years are you traveling for?
Oh, I don't know. I would say probably, if I'm 50, I guess now I got to do math, right? So I would guess, I don't know, 20 years, right? 20. I would hope I could do that for 20 years. And then after that, less often. But even then, maybe every 3 to 5, but even hard to say, I guess.
So that's,
well, it's hard to think, right? Because like I've been working 25 years. If at 50, let's say I live till 90, that's 40 years. So I don't know what I'm going to be
You know, and
doing.
I'm going to give you 25 years of travel. Like I said, this is just a best guess. But let's put, what if you have
Sure.
an extra 20,000 per year between 50 and
Okay.
75 to travel, in addition to the 108,000 or so after
Yeah,
taxes each month that
that's
you
good.
have. Yeah,
Yeah.
just to be clear, this, Spencer, this 9,000, this is after real estate taxes. This is after personal taxes. This is core monthly expenses, correct?
Correct. Yeah,
Okay,
absolutely true. Yes. Mhm.
perfect. So we have that. There's some wedding goals in here. So what we want to look at before getting into the graphs is, okay, where are you? That's your
Oh,
network.
sorry to stop you. I hate it. On wedding goals. I just want to make it clear that's not, if my wife watches that, that's not because I feel like I'm going to get remarried. That's for my kids getting married. I don't want her to think like I'm planning to get remarried. That's
Fair
for them.
disclosure. Well,
Okay.
if you are, I hope you're not getting remarried every 3 years between
No, no, no. Okay.
2026
Sorry.
and 2038.
Yeah, keep
One
going.
marriage
Yes.
all the way through. Same page. Thank you, Spencer.
Yeah.
So those are goals. The income sources that you have. So you have solid combined income today. That, of course,
Mhm.
goes away when you retire. We're going to
Right.
assume a Social Security benefit, but really not until age 67. So that's a ways off, and something we might even want
Yeah.
to do some contingency planning around of what does it even
Okay.
look like at that point for you. But for now, we're going to keep that as is.
Sure.
Savings between now and retirement, which granted is only a couple more years, we're going to assume that you're putting money into your 401ks and max those out. Are you on average doing any additional savings, or does it tend to be you do the 401k and let that do its thing?
You know what? We are so, what's the word? Informal with that. So after we've like, obviously we put everything on a credit card because we pay it off every month. It just helps us organize, keeps everything protected. We pay that off every month. Rental income comes in. Our our normal like job income comes in. If we have a bunch left over, we just put it into savings. So yes, we save more than that. I don't know what the percentage is. If I went back and looked, I could probably, but if we're looking at only until 50, I don't know that it causes too much to change if I'm really specific about how much I'm going to save in the next 18 months or whatever.
I'm with you. I don't think it will change too terribly much. So even if you did save, but let's leave it there for now and start to look at the fun
Okay.
stuff, start to look at the graphs. And so where we're going to actually go isn't actually to the tax stuff right away. Tax stuff comes after we have an understanding of what will income look like and whether income's from salary or rent, which has some
Okay.
deductions you can take about it, has some depreciation you can take against it. What about if income's from Social Security? What if it's from a brokerage account, an IRA, a Roth IRA? So this starts to paint the picture for us of what might that look like? What income sources will we have really starting when you retire and then going throughout the course of your retirement? So if we look at the first full year of retirement, you have no salary and you have no
Okay.
Social
Yeah.
Security. So no taxes on
Yeah.
those yet. You do have, and we're modeling out that you're withdrawing money from your HSA in these years to fund medical
Well,
expenses.
interesting.
There's
Okay.
the
Yeah,
case
that's
to be
true
made.
because, yeah, I was going to say maybe is that better to just cash out somewhere else and just let that continue to grow? I know HSA has some tax benefits but I don't know.
There's certainly the case to do both. On the one hand, you could take HSA early to keep income lower to pay for medical expenses, which allows for more income to be realized on things like Roth conversions. On the flip side, you could delay HSA withdrawals, which allows that to continue growing tax-free to come out tax-free later. So this is just a starting point for the modeling to get a general landscape. And then this is where we can start tweaking things from. But the first quote unquote income source is going to be a non-taxable income source because it's tax-free HSA withdrawal. In addition to that, we're showing income from rental properties. So here's the rental income that you can expect to receive. These are just gross numbers. And you can start to see that income changes as you sell the first condo, as you sell condos 2 and condos 3, as you sell the Airbnb property. So we're modeling out what income might we have in those years, as well as what proceeds might you receive from the sale of that real estate. So again, painting a picture of what income, what taxable income sources might we have coming in. Then expenses. Expenses is, okay, well, what living expenses will you have? This is the $9,000 per month. But then beyond that, what's it going to cost for housing? Now, this ties into the tax picture because depending on whether you're itemizing or taking standard deductions, interest and property taxes may or may not be deductible, but it's certainly an expense that we want to be looking at. Then we have healthcare costs. Then
Right.
we have the cost of maintaining the various condos and the Airbnb property and all of that. So as we
True.
start to look at this, what we're getting a general sense of is what income sources will you have? How does that compare to the expenses that you'll have of just basic core expenses plus housing plus healthcare plus goals? Goals could be travel goals. Goals could be weddings for your children every so often. And when we add all that up, we get a sense of what your total expenses will be, which is this total outflows column. And if every year we compare the total outflows to total inflows, we can get a sense
Right.
for Spencer, how much do we need to pull from your portfolio? And then we look up the tax makeup of that. Is that a brokerage account withdrawal? Is that an IRA withdrawal? Is that a Roth IRA withdrawal? So this is really helping us to get a sense of what will income look like, so we can start to back into what will our tax situation look like, so we can start to understand what tax strategies exist to mitigate any impact of future required distributions. Any questions so far on this?
No, I think this is good information. It shows all these different details that I don't always think about, but when they're shown in this way, it kind of helps me understand it more. So yeah, for sure, that's helpful.
Very good. Well, let's go to required distributions, because again, to summarize, one of your key concerns is, hey, it was helpful, of course, to max out a 401k to get a bit of a tax deduction today, but am I going to pay for that in the future? I know at some point I'm required to take money from my traditional IRA, from my 401ks. Is the tax hit on that going to outweigh the tax benefit of even putting money in? And for this projection that we're looking at here, this cash flow projection, this is not assuming any type of strategy around Roth conversions or other tax strategy yet. This is just, what if you retire and start pulling money out of your accounts? Okay. If you do that, I want you to look at this plan distribution column. This is showing the first plan distribution is just HSA withdrawals.
Right.
Then there's nothing for a while because it's being modeled out as those get spent down. Again, we can have the conversation of, is that the right strategy or not? But no plan distributions until age 75. And at age 75, this number jumps up significantly. What this is saying is these are your projected required minimum distributions based upon the assumed size or the projected size of what your IRA will be at that time. So you
basically, when I'm 75 and the account is a certain size, the government's going to require me to start pulling some out based on how much longer they think I will live, and they want me to start using it, basically.
Exactly. Yeah, there's a few different things to look at from the standpoint, but it's not so much to say it's not a bad thing to have a lot of income until you see, well, what does that do to your projected tax payment? Your tax payment goes from a projected 78,000 and then jumps up, 170,000 the very next year. Because keep in mind, it's not just your required distribution that you're paying taxes on. That's stacking on top of Social Security, which is in addition to things like dividend income, interest income, some of those other things. And that number just continues increasing over time. So that's where I want to focus right now. And then we'll tie into some other things. But does that make sense?
Definitely. It's a good thing to think about, especially this early, where people who are aggressive savers, maybe they need to consider that at a certain point, they're going to have to know that that's going to have to come out.
Well, here's the good thing is, Spencer, you're retiring young. And what that means is your, what we'll call tax window, is very wide. Tax planning window. What I mean by the tax planning window is usually when you're working, your income is much higher. Then you retire and your taxable income is much lower, either because you're spending less or because you're drawing income from places that there's some tax benefit to draw from. So taxable income starts up high, then it drops significantly. People love it. They get used to that. Then required distributions kick in and it pops right back up. And if you retire at 70 and your required minimum distribution age is 73, you have a very narrow tax planning window. You only have 3 years to really try to mitigate some of the impacts there. But if you retire at 50 and your required minimum distribution age is 75, you have 25 years where a bit of good strategy can save a tremendous amount of money. And we'll show what that looks like in just a second here. So what this is showing is, Spencer, here's your adjusted taxable income today if you don't do any tax planning. Well, you retire in a couple of years and your taxable income drops fairly dramatically. Now it ebbs and flows and spikes up and down, but once you turn 75, it really jumps up quite substantially. What this is based upon, so much of this it depends upon, well, where are you pulling income from? Are we assuming that you're going to pull money from your brokerage account first, your IRA first, your Roth IRA first? As a starting point, I'm showing pro rata, which means if you need $100,000 and half of your money is in traditional IRAs, you're pulling half of that 100,000, so 50 from your IRAs. Not necessarily the preferred approach in many cases, but I want to illustrate why real quick. If you take pro rata withdrawals from your accounts, and if we start to layer on the various tax brackets here, we don't want to just say, what is our taxable income in terms of the dollar amount, but where does that put us in terms of the tax bracket that we might be in? And what you can see here is these lines. This blue line is the 10% bracket. The green line is the 12%, which will become 15, so on and so forth.
Different cliffs that I have to consider as the brackets move up.
So yeah, what you're looking at here is, like you're saying, different cliffs. Once you cross this 10% line, income above that is taxed at 12%. Once you cross this green line, income above that is taxed at 12% today, 15% if current tax bracket sunset. Income above the yellow line, taxed at 22%. And so to your first question of, will I pay the piper here by putting money into 401k plans just for it to be required to come out at a later time in a higher bracket? The answer is very potentially yes. You can see here that in later years, you're very much in the top, not the top, because there's a 35% bracket today. And again, who knows what happens at tax brackets over this period of time? It could be even higher potentially. But let's assume that maybe you saved 22 to 24% marginal taxes on any money you put into a 401k, just hypothetically. Well, if you have to pull that out at a 33% tax bracket, it's actually costing you money to put that money into a 401k. Sure, it's a tax savings today, but you're more than paying for it on the back end. So a couple things to note here. The first is pro rata sometimes works for people, sometimes is the ideal method of pulling money out, but rarely, I would say. Not never, but rarely. And just to illustrate what I mean is, if in your specific case, Spencer, you didn't take money on a pro rata basis, but you instead said, I'm going to take money from my taxable account first. Then once that's spent down, take it from my tax deferred. Then once that's spent down, take it from my Roth. That alone would lead to over $3.6 million more in tax adjusted ending portfolio at the end of your retirement, essentially when you pass. So just that alone, just understanding the nature by which you're going to pull out Roth conversions is a major decision. I don't think enough people put enough thought into upfront, is what's the order that I'm going to pull money out of. Does that make sense? Just want to illustrate that before going.
Oh, definitely. Basically, it's like, well, you need to spend the part first that you're going to have to pay taxes on later, so you have less that you have to deal with, and save the tax benefit stuff for later when you would not care about it as much, I guess, I think.
That's a good way of looking at it. Yeah. And so what I'm going to do now is just normalize this. Of what we want to do is compare what if you don't do any tax strategy with what if you do what we'll call the right tax strategy, the proposed strategy. So we're comparing, we're equalizing the base case right now. Taxable, tax deferred, tax free. What do different withdrawal sequences look like? Now, under this, if you do that, you can now see that projected distributions in the future are well into the top tax bracket, even into the 35% bracket. So what we want to do is we want to say, what can we do earlier in retirement to avoid being stuck here, to avoid being in a position where, if we look at this, your required minimum distribution, it sounds absurd to say, but it could be north of $1 million by the time you're in your mid 80s. Now, this depends on spending. This depends on growth rates. This depends on so many things. But as of today, under these assumptions, you might be forced to take out a lot of money. And not so bad to take out money to have that high income, but when it leads to several $100,000 of projected federal taxes paid in those years, that's what we want to see. Can we be smarter about this? So that's where we start looking at this of, okay, what if we don't just start taking money from our taxable account and say, this is great, I'm paying very little in taxes, but what if we start to say, what if we, every year that income is below the 10% bracket, we
Okay.
convert just enough to fill out the 10% bracket. That adds a tiny bit. And it only
Mhm.
adds a tiny bit because there's very few years that you're probably going to actually be under that 10%
Yeah.
bracket already. So it's tiny, tiny conversions that we're doing here. What if, and we just test this, what if you start converting up to the 12% bracket?
Mhm.
Well, now we're talking about something
Significantly
more
more.
meaningful.
Yeah.
Exactly. And the reason for that is this purple graph is what things looked like in the base case. If we overlay this new graph, you can start to see what this now looks
Mhm.
like. So you're paying more taxes up front, but you're paying them at 12%, and it's reducing your future tax liability. It's pulling you under the top bracket. It's pulling you under the second highest bracket to the point that you're no longer projected to be in either of these two brackets. So in other words, you paid 12% to
Basically,
avoid
I'm
35.
kind of like I'm kind of like shoveling money from the future into the present to kind of level it out a little bit. So there's not that big canyon and it can kind of
Exactly.
keep it more steady.
Exactly. It's like having a giant lever today with a ton of leverage where we can make
Uh-huh.
little decisions today, relatively small decisions today in terms of how much we need to convert to have
Mhm.
huge impact on our
Okay.
future tax liability in the future. And so we start looking at say that's great. 1.7. What if we did even a little bit more?
Mhm.
What if they're at up to the 22% bracket?
Yeah.
Now you're starting to talk about substantial amounts of money saved. And this doesn't mean you're not paying taxes, but just if we do a comparison,
Sure.
in the first case, we can start to see here was your projected required minimum distributions. They totaled over $20
Mhm.
million. Under this proposed strategy, your required distributions would actually be a bit under 4 million. To be
Mhm.
fair, it's because you were pulling that money prior to RMD age. So it doesn't mean your distributions are only 4 million. It just means the required distributions are lower. And if you compare federal taxes, you can see instead of just waiting for this giant tax bill in the future, what this is showing is you're paying it more today.
Right.
What I would recommend, and this is difficult to model in the software when you're modeling out a whole bunch of years, but this is where more of
Sure.
the year-to-year tax planning comes in.
Okay.
These are the years, Spencer, when you're projected to sell your properties.
Right.
This
Yes.
is when there's long-term capital gains, there's depreciation
Mhm.
recapture, there's ordinary income from the conversion. So it might not just be a static, do this every single year forever.
Straight.
There is some
Right.
nuance of what else is
Yeah.
happening. How do we account for that so
There's
that
going to be years that we have to kind of manipulate. If we were to sell it one year, that's going to be a year that maybe it's different for sure.
exactly.
Yeah.
Exactly. So I did want to point that out that even if you didn't take in that nuance into account, you're still saving quite a bit of money on taxes doing things this way. So if we go back here, one more thing I want to show is think about this as a lever again of, okay, we have the ability to pull forward some taxes. And actually, you know what? This was actually, is already, this is already doing some modeling ahead of time to say, what if you stopped at age 65? What if you did Roth conversions until then? And you can see that saves 3.6 million. If you never stopped, and you said, what if
Mhm.
you just did this any year that your income was under the 22% bracket? It actually leads to less. So the reason I had 65
Mhm.
and was even prior to this call, just coming in to test this out of you,
Yeah.
if you always converted up to that amount, you would get to this point where you say, wow, this looks amazing. I have zero required distributions under this proposed strategy. That seems like a good deal. And it seems like a good deal because it is in many ways. But just
Yeah.
because it's good doesn't mean it's the best it could possibly be. And when I look at this, what you're essentially doing is you're creating more income up front to have
Mhm.
you're kind of reversing, you're flipping the tables.
Yeah.
Previously,
Right.
you're flipping around the sense of it's not very low income today and very high income in the future. It's now high income today and nothing in the future. We've
Right.
overcorrected at this point.
Yeah.
And so that's where Roth conversions, yes, you should have a strategy. And this is more just general information for people watching. Yes, have a strategy. Yes, have a general sense of what you think you should be doing, but also monitor this every single year because so much of this is driven by what are market returns? What did inflation look
Mhm.
like? What are you actually spending
Sure.
money on? The most obvious thing is what are tax rates actually going to be at some of these times? But one thing we can look at is, look, if you actually stop doing this at 65, that actually saves you more money over the course of your retirement because you didn't
Interesting.
overcorrect. You did a sufficient amount of conversions over time. And this isn't even saying 65 is the perfect age as much as just modeling for you how discontinuing at a certain time, once you've sufficiently managed your pre-tax balances, can actually be more beneficial than carrying out a strategy indefinitely. Does that make sense?
Yeah, I think the fact that just because it works up to a certain age doesn't mean you should continue to do it forever, because you don't want to actually end up having it's still better than nothing, but there's a better way to do it even. Yeah, I think
exactly.
that's my understanding.
Exactly. There's a better way to do it. And sometimes that better way means stopping at a certain age. Sometimes that better way incorporates things like, hey, charitable giving. Is there any charitable giving that's done? Well, let's do that as a qualified charitable distribution from 70.5 and beyond, which means there's less. Ironically, the first thing I look at when we do Roth conversions is, why shouldn't we do Roth conversions? Because Roth conversions cost you money up front. It's not a free lunch. It costs you. And so I first start by looking at, is there a good reason not to? And if you're saying, look, we do a tremendous amount of charitable giving, I'm just making this up as a hypothetical. Well, required distributions become much less of an issue because we can simply use qualified charitable distributions to mitigate a lot of what your required distribution.
So just to clarify, just for round numbers, if you had to take a minimum distribution of $100,000, but you're planning to charitably give $20,000, $20,000 comes out of the $100,000.
Exactly.
So then really you don't have to take out 100,000, you take out 80,000 or whatever the amount. Okay. Correct. Yeah, that's okay, that makes sense.
So that's another really great thing to keep in mind. There's other ways around this. Other things too is you don't always have to convert to the top of the 12% or 22% or 24% bracket. A lot of times, especially earlier on, it does. But sometimes you get to the point where the goal is to manage the IRA balance. Don't let it get too big or too small. Try to keep it at a certain size so that the projected required distributions won't become unbearable. But as we start to look at this, just starting to tie it all in for your specific situation, if we look at the withdrawals and conversions amounts here, what we can start to get is what I'll call an initial game plan. And this is something that should be reviewed every year. Where are tax rates? What has the portfolio done? How have expenses changed? So just keep that in mind. These are all things that should be revisited yearly, but you can start to get a sense for, here's how much I might be converting each year. So you go into it with a game plan. And this is assuming you convert to the 22% federal tax bracket. If you were to change this to the 12% or something different, that would change. But you can start to get a sense of what might that look like. And then you can see here, we're modeling out 0 from there on out, where your balance is in a place where your combined IRA plus Roth IRA plus taxable account, you might not need to continue making conversions to still get, you've already gotten much of the benefit of doing so. Any questions on any of this though, Spencer?
No, I mean, it makes sense that you kind of have to plan, and if you have a big runway, I guess, so to speak, then plenty of time to pump the brakes, then you can kind of readjust and move things around to make sure it's working correctly. So I think that could be beneficial.
That could be beneficial, yes. And not to, this is where we would go next, or where I would recommend going next, is once you have this, then it's okay, how do you position your investments to support the conversions, to support the withdrawals, to support all of this? So we won't go through all of this, but this is just something I'll stay on and talk with you about is, here's the investment allocation of one of your joint accounts. So this is one of the accounts that if you were to do this conversion strategy, you'd probably be pulling from this. Seems diversified. You have several different funds, 1, 2, 3, 4, 5, 6 funds in here. But you start looking this and you can start to see that these funds are pretty much owning the same thing over and over. So here's all 1, 2, 3, 4, 5, 6. Microsoft is the top holding. It's owned in every account. Apple's the top holding. It's owned in every account. Not to say you shouldn't own Microsoft or Apple. These are two of the biggest companies in the world. You should own both. But the goal of owning many of these funds is to see, how do you give yourself different options so that when you do start implementing this Roth conversion strategy, by maybe withdrawing from your taxable account first, if large growth stocks aren't doing so great, it's going to hit every single one of your funds pretty much the same. So how do you start diversifying elsewhere. So I'll go over this with you a bit more in just a second here, but I think in general, for people watching, the goal is to, number one, get a sense of what do cash flows look like. Project out your retirement. What sources of taxable income will you have between rent, between Social Security, between potential part-time work, withdrawals? Start to see what that looks like. You can then get a sense of how will your taxable income ebb and flow and change over time. And that's the point at which you can say, okay, am I going to be in a really high tax bracket in the future because of these required distributions or because of other factors? Then you can start projecting out what should you be doing year to year to mitigate some of that tax impact in the future. So, Spencer, I'll stay on, like I said, to answer some questions, but just want to say thank you for being willing to go through this and allowing us to use
Thank you. That's really helpful. Even though it's not too much time, it's helpful to get all that input and analysis. And so, yeah, thank you very much. That's good.
Very good. Well, thank you, Spencer. Thank you, everyone, for watching this retirement makeover. Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.